What is going on, guys? My name is Tyler and welcome back to the channel. And as you did see today, we had a pretty decent consolidation day. We went up 1.31%, which is a lot better than going down 1.31%. But nevertheless, we're going to be talking about how we know margin calls are coming and how we do know this will be a positive thing for AMC stock. The hedge funds, the institutions, even the big banks are in deep trouble with all of these rule changes coming up. And I do not want you guys to forget what is happening on October 1st. That is going to be very important. So that's what we're going to focus on in this video. We're also going to do a little bit of technical analysis. So with that being said, drop that like on the video, subscribe to the channel, and turn on that notification bell so you'll be notified when these videos are uploaded. Now, let's get into it, guys. And like we did say, obviously a strong consolidation day today, as we did come back down to this really support level that we have had at about $40 per share, currently sitting at $40.84. So it's definitely looking very good. We did go from about $48 at the higher end down to $40, but we're still well above this level that we were at before we did see this big green day, up over 20%, I believe on Tuesday that was. So definitely looking very good that we did find this support at this $40 support level. So looking really good there. And it does look like we are looking for our next leg up. Once you do get this solid support level, after you do see a bit of a sell-off and consolidation period after that first major leg up, you're looking for that next leg up, because obviously still a lot of attention is on AMC stock, and that has not necessarily went away. If we don't see that leg up, we're probably just going to keep going up slowly and steady. We're really going to be range bound in between about $40 and $50 until we break out obviously over $50, heading to about $55, and then ultimately $60 is going to be our real testament here. That's where we're going to see a lot of activity push back into AMC stock from all different ranges, from hedge funds, institutions, day traders, FOMO buyers, and basically everybody's going to be looking at the stock once we do get back up to those levels, if they are not looking at this right now. So definitely going to be a lot of good attention once we do get up to those levels, but it's possible that we do leg up straight through $50, or it's possible that we do slowly start to just climb up to about $50. Anything is really possible here. Let's take a look at the daily volume, and we did see a drop off in volume yet again today, which is definitely a good thing that we were positive on the day with lower volume than we have seen over the past pretty much week. Only at 72 million for volume, even yesterday at 109 million, day before that at 208 million, and the day before that, obviously the day that we did go up 20%, we were at 225 million for volume. So definitely looking good right there that we did have such a drop off in volume and that we were still positive for the day on AMC stock. So can't argue with that too much. Now let's get into this whole margin call situation that we are looking at when it does come down to it. And this is September 1st. This is in quotes from the Bob Stewart, Executive Director, Product Management for Institutional Trade Processing, discussing the impact of Phase 5 of Uncleared Margin Rules, UMR, for over-the-counter OTC derivatives, which kicks in on September 1st, 2021. And this is not OTC as in over-the-counter stocks, pink sheets, as you probably do think when you hear that. This is really big trades that are going on behind the scenes that we aren't being reflected, not on the open markets, not buying puts or calls, but really working with the banks to make these large trades, sometimes billions and billions of dollars. That is OTC, literally over the counter. So definitely this is actually going to impact more money and more trades potentially around AMC than what is even happening on the open market. So in quotes, he says, there will be an upsurge in the volume of margin calls and an increase in the need for third-party custodians to keep safe collateral. As a result, UMR will likely require many buy-side firms to make significant changes to their existing collateral management processes. He continued, many of these processes are done very manually today, often leading to transactional processing errors and settlement failures. It is critical that in-scope buy-side firms are well on their way to be prepared for compliance. So he's essentially saying in that second part right there that they want to start making this automated. So automated margin calls instead of doing this all manually, but also at the same time, by doing this, there's a lot of settlement failures. As we do know, FTDs are a big problem in the financial markets. But basically what he's saying right here is third-party custodians to keep safe collateral. Safe collateral. Safe collateral is seen as treasury bonds. That is why we have had overnight reverse repurchase agreement numbers so high, over $1 trillion for the past couple of weeks now. There's this flood for safe collateral, and third parties will have to hold this. So if you and me made a trade, we could not hold this collateral. It would have to be somebody else that is not in the trade. But essentially what is happening with this is the DTC is no longer going to be accepting short-term overnight treasury bonds as safe collateral for some of these trades. And as you guys can see here, just take a look. As far as today, Friday, August 27th, we did have $1.120 billion worth of treasury bonds that were accepted by the Fed, and these will no longer be accepted, like I said, coming on September 1st. So that is going to be huge in and of itself. But I do think a lot of people are forgetting what is actually going to be the biggest factor to the margin calls. This is not going to be the biggest factor to the margin calls. Yes, this is going to start margin calls a lot more frequently, a lot more often, going to restrict some of the means of different collateral routes that the hedge funds and institutions do have for themselves. But an even bigger thing you guys have to be aware about is this. The Fed sets big bank capital requirements following the stress test. This was on August 6th. It says the Federal Reserve has published capital requirements for the largest banks it supervises. That will kick in October 1st. October 1st is going to be the key day, guys. Do not forget this date. It says Goldman Sachs will have to comply with its highest capital requirements out of all 34 banks subject to the Fed stress test, with a common equity tier 1 requirement of 13.4%. This year's stress test examined 23 banks, with the remainder of the firms on an every other year test cycle. The capital requirements for those remaining firms will be based on last year's stress test. So essentially what this is each bank, they went through a stress test, right? Going over if the stock market fell 55%, if the economy was in total shit, would the bank still be able to lend out to people? Would they be able to function as they normally would? So this, and essentially each bank is different. So this blue right here, the 4.5%, that is what they did have to hold just in general. 4.5% of their total liabilities in cash for their reserves. Now, what this green is the stress test buffer. You guys can see how high this is and how much capital that they're going to have to keep in their reserves. Obviously, 4.5%, like I said, that was what all banks had to keep in their reserves. But because of the stress test buffer, Goldman Sachs is looking at 6.4% additional cash will have to be held. Morgan Stanley 5.7%, HSBS 7.5%, DWS USA 7.2%, USB 7.1%, Credit Suisse 6.9%, JP Morgan Chase 3.2%, and on top of this, a GSIB surcharge. So 2.5% Goldman Sachs, Morgan Stanley 3%, and JP Morgan Chase looking at 3.5%. So now JP Morgan is over 10%. Going from 4.5% to now over 10%. Goldman Sachs at almost 14%, well over 13%, 13.4% to be exact. So this money is not coming from nowhere. They're not digging it out of their ass. They're going to their hedge funds, their institutions, their biggest clients that are taking advantage of this cheap capital, and they're essentially going to have to put up more money. It's going to be the biggest margin call of all times that is coming for the hedge funds and institutions, and that will be on October 1st. But you may start to see effects of this coming probably the second half of September. You're going to see some of that money start to flow back into the banks, but definitely by October 1st, you're going to see the biggest margin call that you have ever seen in the history of the stock market. When we're talking about going from 4.5% capital having to be held in the reserves of the biggest banks, now to some of them, all of them, over 10% requirements, up over 6% for all of these banks. You're looking at trillions and trillions of dollars, and that money is coming from the hedge funds and institutions, the bank's biggest lending clients. So that is all for this video. Drop that like on the video, subscribe to the channel, and turn on that notification bell. Also, check out the 3 links linked down below in the description. There is a free free Discord chat all about AMC. Obviously, there is also a link for the buy and sell alerts. We have been killing it over there, so check that out. Also a link for public. You guys already know the deal with that one. So that is all for this video. Let me know down below in the comment section what you think about this information. October 1st is going to be the biggest margin call that hedge funds and institutions have ever seen. So definitely let me know your guys' opinion on that. But that is all for this video. I will see you guys in the next one.